Good morning, ladies and gentlemen, and a warm welcome to today's discussion on small cap funds, big opportunities in small packages. Now, small cap funds are often underestimated, but their potential tells a different story. Over the past 5 years, small cap market capitalization has grown at an impressive CAGR of 28%, far outpacing large cap and mid cap segments. As of November 2024, the total market cap of small cap stands at rupees 38 lakh crore, showcasing their immense potential. Moreover, sectors like telecom and consumer durables have demonstrated exceptional growth with CAGRs of 73% and 32% respectively. Now, this data underscores the idea that while small caps may seem small, they carry significant opportunities for investors looking to unlock growth. We are thrilled to have with us today Mr. Vaibhav Shah, Head of Products, Business Strategy and International Business at Mirae Asset Mutual Fund, with over 13 years of experience at Mirae Asset and a proven track record in spearheading businesses development, growth strategy, and international sales. Mr. Shah brings a wealth of knowledge to today's session. He has been instrumental in evaluating and launching innovative products and driving strategic growth in the investment space.
Yeah, thanks, Dheeraj, and thanks, Mint, for doing this webinar. And like you rightly pointed, it's a very interesting topic, small cap, especially in this market.
Now, my first question, Mr. Shah, is for investors new to mutual funds, what are the key types of mutual fund categories and how does a small cap fund stand out among others?
Thanks, Dheeraj, for asking this. So essentially, let me first say what are the different sort of market caps as per defined definition from SEBI. So the top companies in India, the top 100 companies by market capitalization, are called as large cap companies. From 101 to 250, these are defined as mid cap companies. From 251 to 500 by market capitalization, these are called as small cap companies. And below 500 companies, you have an entire list of sort of companies. You can call it micro cap sort of companies. So that's how sort of the definition is of large, mid, and small. Now, SEBI is clearly defined as what is large cap, mid cap, small cap, and other sort of thematic funds, flexi cap funds, etc. So the topic for today is small cap. So let me say, what does small cap mean? So a small cap fund has to invest at least 65% of its portfolio in companies which are between 251 to 500 in market cap. The remaining 35%, they have flexibility of investing in mid caps, in large companies, or even in companies below 500 in market capitalization. So the universe is sort of quite large to choose stocks, especially for small cap funds. And as you see in India, there are more than 5,000 listed companies in India. So you have, as an investor, a lot of options that you can choose while making the investments.
Now, why should investors consider small cap funds as part of their portfolio? What are the key benefits these funds offer?
Sure. So, Dheeraj, like you had rightly said in the introduction, the name is small, but the potential is large, right? So, small caps, by definition, have a huge potential of growth. We've seen that, the small cap index was launched sometime in 2005. So, it will complete about 20 years of history. And in this 20 years, the small cap index has generated anywhere from about 17-18% CAGR returns over this 20-year period. It has had its share of volatility when market cycles go up and down, but over a 20-year period, to generate 17-18% sort of return is sort of a quite large, I would say, return potential of the small cap companies, especially if there's a magical number called as 72 divided by R, which helps you understand how many years the money sort of doubles. So, if the index can generate this sort of wealth, your money can, double at a much faster speed. And well-managed funds in the past have shown this ability to generate 3 to 4% higher returns than the index. And hence the compounding for investors becomes even much better. So, of course, one of the largest advantage of investing in small cap is the return potential. Of course, albeit with a lot of volatility, and how you can navigate volatility, maybe we can cover in the subsequent sort of discussion. Another important thing for small caps is that Small caps are able to give you a wider investment choice. So, as you did in the definition, small companies are actually between 251 to 500 in market cap. And also, you have the option of investing companies, either as large, mid, or micro cap. So, the investment universe is large. And compared to large caps, which is sort of restricted to about 100 names, and you have to have 80% of your portfolio there. In small caps, the number of stocks are large, so you have a much wider variety to invest. Third, what we've seen in India
Mm-hmm.
is, the demographics of India is 140 crore population, average age of being 28, and India having the largest working population in the world. Many companies which are there currently in the small cap segment are giving out investment opportunities which are very, very large in size. And a lot of sectors in India are currently not available at all in the large cap index, but are available only in the mid and the small cap index. So many sectors like capital markets, hotels, infra, agri, you know, consumption oriented businesses, hospitals, etc. The representation of some of these sectors in the large cap index is fairly low, while the representation in mid and small cap segments is large. And as the demographics of India plays through of consumer, aspiring for a better life, I think some of these small companies can move up the curve from being small to mid to large. So larger sort of investment opportunity, many sectors which are sort of underrepresented in the large cap index, and I would say potential being large. If you were to put all of this in context, investors have a varied investment options when they invest in
Mm-hmm.
sort of small caps.
You talked about the volatility part. So, you would agree to the statement when I say small cap companies are often perceived as volatile. Could you help our viewers understand the potential risks associated with investing in small cap funds?
Yeah, so Dheeraj, you are rightly pointed out. See, if the return is high, the
Mm-hmm.
risk also has to be slightly higher, right? There is no free lunch, as we keep saying. So in markets, if the potential return is high, there will be sort of more volatility. And why there is slightly more volatility in small caps? There are few reasons for that. One is, if you see the market cap of small cap companies, uh, they are currently between say about 8-10,000 crores to about 27,000 crores in market cap. Now, most of the companies are not as liquid as some of the large cap companies, and hence the trading volume which you see on the exchanges is slightly low. And hence, when market goes through its sentiment cycles of up move and down move, you would see that small caps get impacted more, because if investors panic or they want to sort of take out profits or redeem investments, there's not enough liquidity. So one key risk always remains liquidity, and liquidity is one of the reasons for volatility. Second is, some of the small cap companies are not as well researched as the large companies are. So when a lot of market participants sort of cover many companies, you can see a better price discovery happening, which I would say to some extent is not there in small caps. So the risk factor of liquidity and information which can be available with all market participants is low, which causes volatility in small caps. However, what I want to point out is small caps of the past. So small caps, about 5 years back, what had having a market capitalization of only about 2,000 to about 8,000 crores. So the size of the opportunity in the next, in the 5 years has grown from 3 to 5 times, as market capitalization has grown to 8,000 to 27,000, which means investors can enter and exit much better, price discovery is better, more broking companies are covering small cap stocks. Some of the size of small cap funds have also become large, and they are very key players in this segment. Hence, I would say the volatility which we used to see in the past few years has gone down drastically. And as the flows from both domestic and foreign investors become larger in this segment, I would say volatility in the next 4 or 5 years will go down further, and it will improve the potential for investors. And we always keep saying that the one way to sort of navigate volatility is to invest systematically. So we've seen
Mhm.
that in small cap funds, if investors take a staggered investment option through both SIP or STP routes, then the volatility comes as an advantage or as a friend for the investors, because volatility will mean better entry points for investors, especially if your time frame is sort of large. So these are some of the ways I would say volatility
Mhm.
can be managed for small cap sort of funds.
Now, we have seen, Mr. Shah, that market capitalization thresholds for small cap funds have evolved significantly. Can you share some insights into how these funds have grown over the years and why now? Why now is a good time to explore them?
So Dheeraj, what like I was saying in my earlier point, uh, maybe 5 years back, mid
Mhm.
cap stocks had a market capitalization between 8,000 and about 27,000 crores. And at
Mhm.
that time, small caps had a market cap between say about 2,000 to about 8 9,000 crores. 5 years hence, by 2024, mid caps have become from about 85,000 all the way to 27,000. However, small caps have become from from the bottom 500th companies market cap being 2,000, they've come to about 9,000 crores, and the top companies market cap from about 9,000 has become almost 27,000 crores. So the small cap of 2024 are how I would say the mid caps were of 2019. And I would believe they maybe 5 years from now, 2029, I won't be surprised if the small caps of 2029 have a market
Mhm.
capitalization equal to the mid caps of 2024. So from here, there could be a much better improvement in the market capitalization of small caps. We've seen that the participation of retail investors has grown
Mhm.
significantly in small cap funds. And in fact, small cap category has become one of the largest category in the mutual fund industry on the equity sort of oriented funds. So there's a lot of participation from retail investors because they can see the potential of this category. And as sort of this category keeps getting more flows with better participation from domestic and foreign investors, I think so the market capitalizations will not only grow, but the opportunity size will also grow. Interestingly, some of the small cap funds that are there in this industry are also not small in size. Some of the funds are 50, 60,000 crores in size. So you can't call a 50, 60,000 crore fund as small. So they are very large size of funds.
Mhm.
And uh, as I said, some of these things happen and India sort of continues to grow. We see this segment sort of doing quite well from a long term perspective.
Now let's talk about the criteria. What criteria should investors keep in mind when selecting a small cap fund? Are there any specific parameters such as fund manager expertise or sectoral focus that they should evaluate?
Sure. So, I know some of the points we covered in the earlier part. I
Mhm.
would like to say when an investor looks at a small cap fund while investing, right? Uh, what are the parameters that they should look at? See, when a fund becomes significantly large in size, it will have an impact of how quickly it can enter and exit a stocks. So when an investor wants to make an investment in a fund, now SEBI has mandated mutual funds to do stress testing for their portfolios, which helps to know how liquid the portfolios are, what is the impact cost an investor faces while sort of making the investment. Now, this data is sort of available with investors, and a beautiful part about mutual fund industry is that the transparency of the industry is sort of very high. All mutual funds have to disclose the entire portfolio of the underlying stocks on their website, and that helps investors know where the actual investments are also happening. Now, using some of these sort of information, investors can make a much better informed decision to understand, are the funds that they are investing in liquid? Is their portfolio liquid or no? What would be the impact they would face while sort of buying and selling those funds? And are the portfolios having maybe too many stocks as part of the portfolio? Because uh, you know diversification is good, but over diversification is also not great. Yeah. So Warren Buffett, who's considered the god of investing or father of investing, always says, if you know where you're investing, there's over diversification negatively impacts your return. So as the funds sort of become very large in size, uh, if we see that some of the funds sort of have 100, 200 sort of stocks as part of the portfolio, then you would sometimes think whether the ability to generate alpha will sort of diminish from where they had returns given in the past. So investors have to do their own education, and that's where I think so. Taking help of advisors also becomes important, because the advisors can guide them to decide, which are the funds that the investors can look at. Idea is to invest in funds which have a sort of a strong track record across market cycles, and fund managers who've sort of given the capability of managing funds across cycles. If investors can sort of navigate all of this, I think size and liquidity will not be such a large challenge for investments.
Now, when we talk about retail investors, liquidity and safety are always top on their mind. How do small cap funds fare on these parameters, and what should investors be actually cautious about?
Sure. Uh, all of us know that, say, compounding is the eighth wonder of the world. I would say, this is my personal view, that SIP could be defined as the ninth wonder of the world, because SIP is sort of a disciplined way of investing, and it sort of helps you navigate volatility. See, what is the concept of SIP? It's a very simple concept that as market corrects, it helps you buy more units. So when there is more volatility in markets, then you would be able to buy more units when they sort of correct. And when market goes through the up cycle, you can get the advantage of all the sort of uh, disciplined way that you would have invested and bought more units when market fell. Also, SIP takes away the overall thought of fear and greed. Always, we remember that beautiful saying Warren Buffett says that be fearful when people are greedy, and be greedy when people are fearful. Now 2024 was a classic example when people were sort of greedy, and it was a time to be actually fearful, maybe take some money off from the market. And 2025 has started on a different note, where investors have suddenly become very fearful because markets have corrected about 10-15%. Now with this sort of correction, and with the long term potential of India being sort of good, it might be a good sort of entry point for investors to start investing in markets. But investors tend to become sort of fearful. When you invest in SIP, you actually take away this thought of greed and fear, because you're able to buy systematically in markets, irrespective of looking at whether the market is 80,000, 76,000, 85,000, etc. And as market sort of corrects, it helps you buy the
Okay.
more unit.
Now, continuing on that part, we would love to know what are some generic best practices for retail investors when it comes to building a balanced and a diversified portfolio.
Yeah, I think one thing that I would always suggest retail investors to do is first to be not be return chasers, right? Uh, the problem of market always happens is that you chase the last sort of best performing category or best performing fund, and assume that that will sort of continue for the next few years. If you were to see mutual funds, we always in our presentations have a very famous disclaimer which says past performance may or may not sustain. Right. The idea is to tell investors, just don't look at the past to sort of make the investment choices. So first and foremost, don't be return chasers, because in return chasing, you tend to over allocate to sectors or categories which have delivered the highest returns in the past. What investors need to do is sort of create a strong asset allocation strategy, which will ensure that they don't over allocate to maybe large, mid, small, or any themes over and above what they should ideally do. And that's where, taking help of an advisor through financial planning and hearing such webinars, which, uh, all such publications are creating, can create that awareness. So, most important is to follow asset allocation and allocating the right sort of money between the three segments of large, mid, small. not being sort of return chasers. Also, what happens in funds is that a fund may sort of do very well in the last 6 months, 12 months, or a couple of years. What investors need to do is also to do little bit research on the consistency of the fund manager in delivering alpha across time frames, and also the sort of investment process and consistency the fund house has across funds over different categories that manage. This helps them give confidence whether the sort of fund house has this ability to be able to sustain the performance that they have sort of generated in the past. So looking at some of these points is very, very important. And I always believe that taking help of financial advisors is very, very important for retail investors to navigate markets and take the sort of better investment decisions.
Now, an interesting question coming your way, Mr. Shah, that small cap funds are known for discovering undervalued companies with high growth potential. Could you share a real world example where such an investment has paid off significantly?
So Dheeraj, one thing on the mutual fund industry is that we don't talk stocks, right? The idea is, when you create a portfolio, actually, of maybe when you invest in funds, the idea is that one stock or maybe few stocks should not impact the overall returns of the fund, because it means that some stocks had done very well, and they would have definitely helped the NAV and the returns. Idea is to create a portfolio of maybe 30, 40, 50 stocks, which can be well diversified across sectors, across sort of themes and investment ideas, which can sort of create long-term wealth. We've seen that when performance is driven by few stocks, it helps, it sort of creates more volatility in future returns. Though the current returns might look sort of quite attractive, but future returns could also be impacted. Hence, I would always suggest that investors to look at portfolios from an overall portfolio perspective rather than sort of few stocks doing sort of well. Second is, uh, while choosing funds, also look at, are the portfolios not having too much concentration risk in some stocks, right? So especially in this segment, like I mentioned, some of the funds have become fairly large in size. So if your holdings are fairly large, if there is some negative news flow in some of these stocks, it would be not possible for any fund to sort of exit some of these holdings on a very short period of time. Hence, you have to also look at portfolios to ensure that concentration risk is not there. And I would say, maybe on your point, is small cap universe has so many sectors which are consumers to manufacturing related industries. It's more domestic consumption related opportunities which the small cap index is catering to. And as India grows from being currently the fifth largest to the third largest, and hopefully in the next 20, 25 years to be one of the largest economies in the world, some of these segments will have a huge growth potential, which you can sort of invest in. And the advantage small cap fund is having is that when some of the small companies that you invest, even if they become from small to mid to large, you can continue to remain invested in those stocks if you still feel that the runway of growth is sort of very large. So rather than giving sort of names of stocks, I can tell you one data point which is very important. In
Mhm.
the last 5 years, 60 sort of small cap stocks had actually given more than 5x or 500% return. 60 small cap stocks gave about 300 to 500% return, and about 40 stocks doubled uh, in this sort of 5 year period. So if you were to see the universe of small cap stocks, out of 250 stocks, about more than 150 stocks doubled your money. Of course, the last 5 years were sort of extraordinary years in markets. Maybe this sort of trend cannot continue also always in the future. But idea to showcase here was the potential to find many multi-baggers is very, very high in the small cap because they are under research. And as they sort of continue the strong growth, their P gets re-rated, and market rewards some of these small cap companies very high. I think so all of us would have seen the life cycle of any company. So when a company starts, the first 5 7 years are the toughest phase, where it sort of survives, tries to create a brand for itself, and then it becomes from an SME to a micro to a small to a mid cap, and then becomes a large cap. I would say the fastest growth for a company lies when it moves from becoming, I mean, SME to a micro to a small and then to a mid cap. Now the advantage is there are in India enough and more opportunities across sectors that you can cater to. And the segment that we talked about, small caps, has the highest, so I would say, one of the better opportunities of catching some of these companies young and letting them grow as they become sort of large cap companies. Maybe just a final point on the question is that many of India's large cap companies of today, actually, when they were born maybe 20 years back or 10 years back, were actually small in size. So you're not born large, you sort of born small, and you sort of
You grow.
start the journey up. And if you can identify some of those companies early, then definitely the return potential is sort of fairly large.
And lastly, with market conditions constantly evolving, how can investors stay updated and make informed decisions without overreacting to short term market movements?
Dheeraj, you actually pointed a very, very important thing, uh, that how should they sort of be very disciplined and not overreact, right? So 2024, like we discussed, was a year of euphoria. People thought
Yes.
money making was easy. In fact, when I used to meet a lot of investors, they used to tell me, oh, 25 30% return in markets, that's too low, right? So people had become slightly spoiled for choice, and the returns are quite high. I think so when such sort of markets happen, you would see either a time or a price correction happening, which is good for the health of the market. Markets in the long term are a slave of earnings. As investors, you have to only see is the sort of large, mid, small segment that you are investing and the companies that you are investing, will they continue to have a strong earnings growth? If those segments and companies that you invest in have strong earnings growth, then uh, market noises or volatility will be there, but in the long term, investors will be rewarded, because as the companies continue to grow, I'm sure share prices can continue to grow. And when you have such sort of periods, very important to stick to asset allocation, very important to invest through SIP stroke STP mode, along with some sort of lump sum investments. Take help of advisors to decide the changes you need to make in allocation, attend webinars, read sort of more material. But idea is to educate yourself. Sometimes the best sort of thing to do is to do nothing, right? So if you were to see the mutual fund industry, the oldest funds in the industry, which started an NAV of 10, some of the funds over the last 30 years have crossed even more than 1,000 in the NAV. And what did the investors do? If you held on to that fund and did nothing, your money would have multiplied. The classic example is Sensex. Sensex was born in 1979 at an index from 100. If you did nothing, you would be close to about 76, 77,000. If markets give up or go down couple of thousand points, should not matter, because you started early and you rode the entire journey. So invest long term. Keep a mind frame when you invest in small caps of at least 5 7 years. And I think so as India emerges one of the fastest sort of economies in the world, this segment could have the potential to generate better returns and better investment experience.
Well, very well said, Mr. Shah. Now, that wraps up our today's session on small cap funds. With their ability to uncover niche opportunities and deliver substantial growth, they offer a compelling case for inclusion in your portfolio. The segment's market capitalization has quadrupled over the past 5 years, and industries such as healthcare services and industrial products have been significant contributors to this growth. However, as with any investment, a thorough understanding of risks and strategies is paramount. We extend our gratitude to Mr. Vaibhav Shah for sharing his valuable insights, and also to Mirae Asset Mutual Fund for supporting this initiative. And a big thank you to all of you for being part of this session. And we look forward to bringing you much more enriching sessions in the future. Happy investing and take care.
Mutual fund investments are subject to market risks. Read all